So switching gears here, let's look at the week that I had last week, and then we'll also look ahead to earnings that are coming this week and how I plan to position myself in the week to come. When we look at last week, it looks like I made $848. I did so by, looks like selling a put on Lowe's, selling a put on Target ahead of earnings. I guess Lowe's was ahead of earnings as well. I bought 200 shares of Tapestry and cashed out for about 290 bucks. I sold a put on UPS, and that stock actually went up yesterday. I don't know what's gotten into UPS, but man, they just go up every day. I'd like to get back into them, but I want to do it at a reasonable price. I want a better than good price. I want a great price. I sold a covered call on Lowe's and got 77 bucks, and I sold 2 puts on Applied Materials. And so what am I doing this week? So the biggest thing I'm going to do this week is actually a very interesting bet, at least to myself, is that I'm actually buying Applied Materials. I bought it on Friday for about $105 flat. And the reason why I did that is because this company just beat earnings by 8.66%. They beat revenue by 4.01%. Analysts were expecting $1.79 a share. They got $1.94. They were expecting $6.27 billion in revenue. They got $6.52 billion in revenue. And now analysts are saying, well, who are they going to sell to in the future? And I'm like, well, genius. It's whoever they sold the $6.52 billion before in all likelihood. What do you think? They're buying this stuff themselves? But for this great quarter, they were rewarded with a drop of 3.36% in their stock price. And so what I see here is a fantastic opportunity for buying Applied Materials. I think that it's not out of line to think that they might go back up to say $110, $111. If I look at them in the long term, I don't think that 110, 111 is bad. I got it for 105. I think I can make about $500 or $600 out of this, possibly even this week. And in any case, it's not a company that I mind holding on to. When you look at Applied Materials, we're looking at a company that trades at a price to earnings ratio of 14. It's got a forward PE of about 14. Also expected to grow a little bit, but their PEG ratio is very nice at 1.02. They also pay a dividend of 0.99%. They pay $1 a share. And they also have a profit margin of 27% profit margin, which is very nice, and an earnings growth forecast of 13.77. They are not highly shorted. They only have a 1.33% of their shares are sold short. When we look over at the Morningstar, they believe that the fair value for Applied Materials is $142 a share, and I bought them for $105. And then also, this company is really good at returning equity to shareholders in the form of buybacks and in the form of dividends. And so, and then I think they're going to buy more of their shares back right now because their shares are an incredibly good price. And with the 1% tax that's coming here on January 1st of 2023 on stock buybacks, I believe that means that Applied Materials is going to buy their share back sooner rather than later. For all these reasons, I'm very bullish on Applied Materials, and I think that this is going to be a company that I bought 100 shares of, and I'm hoping that they're going to go ahead and produce for me really quickly. And I'd like to be able to sell it for say $110, $111. I might even sell a covered call with a $111 strike, and I'll strangle it with a $99 strike sold put. All right, so for earnings, what we've got coming up this week on Monday, we've got Palo Alto Networks, ticker symbol PANW. They sell for about $500 a share. It's not something I mess with, but it is a popular stock among hedge funds. They're not profitable, so I don't want to mess with them. Although, for whatever reason, cybersecurity stocks have been largely unaffected by the bubble pop in non-profitable tech. Zoom also comes out on Monday. I don't think I'm going to take a position there. Advanced Auto Parts is one that I do tend to take a position in. I'll take a look at it and then we'll see what I'll do there. I bought 400 shares of Macy's, which I might regret. Actually, I don't know that Macy's will go up much, but I don't think it'll go down much either. It's trading so short. Along the same lines is going to be Nordstrom, ticker symbol JWN. They're also reporting on Tuesday. We have Toll Brothers reporting on Tuesday as well. That's going to be interesting to see how they come out. I always like to look at the housing stocks. On Wednesday, we have NVIDIA, which is like a love-hate relationship with NVIDIA. You know, my cost per share on NVIDIA is something like 55 bucks. I've done it already because I made so much money on them over the last couple of years. But this is the stock that's keeping me down this year. Actually, I am up for the year, but NVIDIA is doing what they can to make sure that I finish down. Also, reporting on Wednesday is going to be Salesforce. It's not a company that I really like, though I know it's a popular company among professional hedge funds. The reason why I don't like them is I don't know what they do. I just don't know what that Salesforce offers that, say, Microsoft doesn't. I don't know what they are. Snowflake is another one that hedge funds just absolutely adore. It's another non-profitable tech company. It's a cloud server. I don't know what they do also that Amazon, Google, and Microsoft don't do. It's not one that I'm very bullish on at all. Williams-Sonoma, that's a very interesting play this week. I'm going to show you where the hedge funds are positioned on Williams-Sonoma and what I might do, and it's going to be an unusual play. You need to check that one out. Also, reporting on Thursday is going to be Dollar General. Dollar Tree. Dollar Tree might be one that I make a play on. Marvell is not profitable, so I will not be making a play on that one. Ulta, much like Palo Alto Networks, is a very expensive stock. I won't be making a play on them either because they trade for like over $400 a share. And stocks that are that expensive eat up an awful lot of your margin. So let's say I want to sell one put on Palo Alto Networks and it sells for $500 a share. That would cost me $100,000 in margin equity for me to be able to do that. It's just not something I'm interested in. And Ulta falls in the same ballpark at $400 a share. So it's another one that I won't be making a play on, though if I had to make a play on either, it'd probably be Ulta. And so in my view, these are the most anticipated earnings for the week. It's not my most anticipated play of the week. Of course, I'm looking at Applied Materials. They actually reported last week, and it was something that I really liked and something that I think I can capitalize on. Because for me, this market is you kind of figure out what something's worth and then you pay less. And so I think I paid less than what Applied Materials is worth. I think it should go up over the course of the next week or two, maybe even month. And I should be able to net about $500 or $600 on that trade. But let's go ahead and see what else is coming up this week. So on Monday, like we said, we had Zoom coming up. And Zoom Communications, we all know what it is. I'm actually recording on Zoom right now. They are a company, they have a price to earnings ratio of 27, which is not a discount to the S&P. It would be fine should it be trading with a lot of growth. It doesn't appear to have any growth, even though its forward PE is less than its previous PE. But nevertheless, it's still an expensive stock and probably one that I'll be staying away from. Its profit margin is really nice at 29.92, and its short interest is fairly low at 3.87. Their income statement shows that they have had some really consistent growth over the years, almost like 100% year over year. And so it could be a really good company. What I don't really like about them is the fact they are just so one-dimensional. They need to diversify much the way that NVIDIA has diversified away from gaming and into something else. They need to diversify into something else, perhaps cloud services or maybe edge computing software, or what's another one that people like? Maybe security, cloud security. Maybe they buy one of those firms or something like that. But they need to get into something else. And right now, they're just not doing it. I don't know why. But let's go ahead and have a look at their technicals. So Zoom is trading here in this range here. It looks like a fairly safe place to sell a put on would be about $82. It's not something I plan on doing, but if I was, I'd probably be in the $82, $83 range. And next up is going to be Toll Brothers. They report on Tuesday. Toll Brothers is a funny one because they're one that I might actually make a play on because it looks like if you can get in here about $43, it's very safe. I can't see any reason why it would fall from 47 anywhere below, like say even 44. So I think 43 is very safe. And the reason why I like that one so much is because when I go over here and make a trade on Toll Brothers and I do with a $43 strike, the premium's actually not that bad. So if I go ahead and I sell a put on it with a $43 strike that expires on the 26th, I'm getting $40. And I don't even think it's going to go that low. And I could do it for 44 as a little more greedy, but I'm just not going to do that. But if I sold 3 of these puts for $40, it gets me $120. And I think this is money in the bank. And so what this means is if Toll Brothers finishes below $43 by the 26th of August, I'm on the hook to buy 100 shares of Toll Brothers at $43. So if Toll Brothers was $41, I still have to pay $43. If Toll Brothers finishes at say $45 or $44, I don't have to buy any shares, but I still get to keep your $40. And this is one that I might be making a play on, and maybe even selling like several puts with a $43 strike to see if I can't make about $100. Next up on this list is going to be Advanced Auto Parts. This is one that I will sometimes make a play on. I like Advanced Auto Parts. They kind of remind me a little bit of, say, a Costco or a Lowe's, in that they do give to the regular consumer, but they do also have a professional client base. So if you're in the car repair business and you need to buy auto parts, you might just use Advanced Auto as your partner in getting parts so that you can run your own business. It is trading here near the top of their channel. It's not one I'm very excited to get into. Normally it is one that I will get into, but if they do come down a bit and I can sell a put for about $183 with a nice premium, I'll go ahead and do that. If you look at the fundamentals of Advanced Auto Parts, you can see that they do trade at a very decent price relative to the S&P. They're trading at 21 times earnings with a forward PE of 15. That's very nice. So what we're really looking for from them is going to be some growth. They have a great dividend, which is actually about the same as a 10-year bond yield at 2.9%. They have a profit margin is kind of skinny here at 5%, but they do have a nice growth forecast. When we look at the percent of shares sold short, we're seeing it's kind of high at 6.86%. And then when we look at their income statement, we see that the reason for that is they don't grow a whole lot. They do grow a little bit, but not a ton. But nevertheless, it's growth, it's stable, and they have very few competitors. I'm thinking about maybe AutoZone, O'Reilly's, and maybe Napa. So I do like Advanced Auto Parts. Next up on this list is going to be NVDA. NVIDIA is a stock I own. It's a love-hate relationship. You know, sometimes I love NVIDIA and sometimes I don't love NVIDIA. This is one of those years where I'm not that crazy about NVIDIA. NVIDIA does trade pretty rich, and they are an interesting company, and they are one that did pre-release their earnings. So I think a lot of the news for them is already baked in, remains to be seen. They report on Wednesday. They have a price to earnings ratio, which is 48, and a forward PE of 42. They don't pay much of a dividend. They have a fantastic profit margin and a fantastic growth forecast. Their number of shares sold short is pretty negligible at 1.34. So any sort of bounce that we would get at earnings, we wouldn't expect it to be any sort of short squeeze situation. They're a company that did pre-release their earnings. They did it right here. They show that they are expected to only produce $6.7 billion this quarter versus $8.1 billion expected. And that's being driven by weaker gaming revenue than expected. However, this company has diversified beyond just gaming. They are now big into automotive sector. They're big into data center. Data center is actually where they're making a lot of their money. Data center revenue was up to $3.81 billion, which is up 1% quarter over quarter and up 61% from the previous year. A lot of this has to do with the fact that they have that partnership with ARM to give themselves the fastest microchips in the world. And now I wouldn't be, maybe I've watched too many Iron Man movies or something like that. But for something like NVIDIA, I'm not sure that they wouldn't get into defense contracting or something along these lines. These guys seem to be able to make anything they want to. And my plan for them, since I already own them, would probably be to buy a collar. And what that is, a collar is where you sell a covered call out of the money, and then you buy a protective put out of the money as well. So I might be selling a covered call and buying a put on NVIDIA. And what would my strikes be? Well, I'm not going to be doing it right away. What I'm hoping for is there's a little bit of fervor going into earnings and it goes up to say 200. Then I can buy my put with like a 190 strike and I can sell my covered call with a 210 strike. If it doesn't go up, I don't see myself doing anything at this level. I'll probably just let it go through earnings and it will do what it does, because I think it's more or less priced in the pre-release. But no, Jensen Huang is a very smart guy. He might have done this because he's got a little bit of a trick up his sleeve that might send this share price higher. I don't know what I'll do, but if the share price does go appreciably higher prior to Wednesday, I will be buying a put at probably 190 and selling a covered call at like 210. But in all likelihood, I'll be doing nothing. Next on this list is going to be Williams-Sonoma. They're an e-commerce furniture retailer, much like Restoration Hardware. They trade for $162 a share. They do trade at a very reasonable price to earnings ratio of 10 and a forward PE of 10. So they're not expected to grow much this year. They do pay a dividend of 1.92%. They're a fantastic company. They have a net profit margin of 13.74 and a growth forecast of 4.65. However, this is something that I think is very interesting. The short interest on Williams-Sonoma is 18.6%. That is massive, especially when you have a company that grows like this, the way it's been doing. But the reason why it's got such a heavy short position is what a V. This has been, look at this run since June 29th. It was $9, $106, and now it went as high as 175. It's currently sitting at $162. So this thing has had a huge run. So a lot of people are thinking that no matter what they report on earnings, that this company will at best stay level and at worst crash. And so a lot of people have puts on this, and I myself might actually buy a put with say $160 strike and see what happens. Maybe it will crash down to 130. You never really know. Another line of support would be like 133. Maybe it gets there. That could be an interesting play, is buying a put on Williams-Sonoma to see what happens after earnings. Because if they don't shoot the lights out, this thing is coming down. All right, so next on this list is going to be Dollar General. Dollar General is not a company that I'm that hyped on. Maybe it's because I've been in a number of their stores and I'm just still haven't quite figured out how they make so much money. But anyway, they are a decent company, but they do trade very rich relative to the S&P. And now we're talking about another consumer staple that trades rich. They all do right now. Like, people would be crying. They do cry about Apple and Microsoft trading like this, but they don't cry about Dollar General. And I never figured that out. Google trades cheaper than this and they cry about that one. But yet Dollar General, it's okay. It's a staple. It's okay. So it's okay to trade really rich. They have a very thin profit margin, obviously. They're a discount retailer. They trade at a profit margin of 6.58, which is better than I thought it would be. I thought it'd be closer to 2. They have a very nice earnings forecast, growth forecast of 11.5%. There are not very many short shares out there of 1.84%, and they do seem to grow a little bit year over year. Again, it's not one that I'm super hyped on, but if I was going to get in on this one, I would go ahead and get in on this one around the, say, $239 level, maybe sell a put here. That seems to be a pretty good spot of support. It's currently sitting at about $253. So if we can get it for $239 and they can give a good premium, it seems to be a good line of support over the, what was that, $238. Not a bad line of support over time. I might just be on the safe side, get it for like $235, just in case it runs down to, pretty close. And I don't want to get scared because I don't want Dollar General. But that would be where I would set a put. $235 strike on DG would be about $170 in premium. So that's not bad. Actually, that's not a terrible play. I don't really like Dollar General, but I don't mind this premium, and I don't think it gets there. Next up on this list, similar to Dollar General, is going to be Dollar Tree. Now, I tend to like Dollar Tree a little bit more. I don't know if they sell groceries or not. I'm not sure. A good price for them might be about $53. If we look at their fundamentals here, we can see that Dollar Tree is trading right now for $167 a share. It's got a price to earnings ratio of 25 with a forward PE of 20. Again, it's a consumer staple, so nobody's going to complain about that. It's got a net profit margin of 5.5%, similar to Dollar General, and a growth forecast, which is actually greater than Dollar General. Its short interest is very small at 2.37%. It does have the similar type of growth pattern to Dollar General, although like I said, I don't remember any groceries coming out of there. If I was to trade that with, say, a put with a strike price, an expiration date of next week, and a strike price of $155, wow, I could get $317 in premium. It seems as though the street thinks that this stock's coming down. I wonder where I could get like for $100. That's still $194 at 147? $20 down from where it is today. They're expecting this stock to crash, folks. What can we get it for, like 100, maybe $137? Wow! You can sell it $30 out of the money and collect $91 in premium. Bang! Here's a good play. I'll be making a play on Dollar Tree. I'm gonna sell it way out of the money and see if I can't score $100 because that's just the kind of guy I am. All right, so next up on this list, I'm going to talk about Macy's. This is a company that I do hold a position in. I've got about 400 shares. It's a company that's in recovery. It's like rebounding. They have a lot of debt. They are changing their business model. They could be what's considered a recovery play. They traded a price to earnings ratio of 3.48 with a forward PE of 4.3. They trade with a very nice dividend of 3.25%, which is better than the 10-year treasury yield. And so that's the reason why I don't mind holding them, is because of low valuation and high dividend yield. They are a company that is, like I said, they're in recovery. They have a profit margin of 6.21%. However, they are not expected to grow this year. They also have a very high short interest. So with a short interest of 9.87, should they shoot the lights out, and I'm not expecting it, but should they shoot the lights out, you could see a bit of a squeeze out of this company. When we look at their income statement, they do grow. They stayed pretty steady around 25 billion a year, but then they shrank in 2021, much to be expected as people were not out and shopping, and then back up to the $25 billion range. And I would expect this year again, they would be in the $25 billion range. So this is a company that I bought shares in because I don't mind holding it. It's a pretty small position for me. We'll see how that goes. Next on this list is going to be Nordstrom's. They're very much the same as Macy's. However, I think of Macy's as being kind of more accessible to the middle income earner than, say, Nordstrom's is. Plus, Macy's has they do have a high-end retailer in Bloomingdale's, which I've never actually seen a Bloomingdale's, but I've heard of them. But they do trade with Bloomingdale's, and they do have a nice online product as well. Nordstrom's might also have a nice online product, but I'm not sure. I've not really looked into Nordstrom's that much because it's not one that I ever trade in. They traded a price to earnings ratio of 10.67, which is triple that of Macy's. However, they are expected to grow. And so their forward P is 7.95. They have a net profit margin, which is incredibly thin, much half that of Macy's. However, their growth forecast is fantastic at 29.96%. They do have a short percentage of shares that's out there at 16%, which is very, very high. And again, that leaves them vulnerable to a short squeeze situation. They were trading with about $15 billion a year until the pandemic, which would, of course, we'd expect that to come down to 10. It's back up to 14, and that's the reason why they're expected to grow, because I think most analysts would expect they get back to where they were, say, in 2019 at $15.8 billion. So this would be another play to get into this earnings cycle. A quick look at their technicals shows that a good place of support here would be roughly $22 here on Nordstrom, ticker symbol JWN. $22 looks all right. Let's see what kind of premium you get for selling a put with a strike price of $22 that expires on next Friday. It looks like $84. That's pretty good. That might have to do with the large short position they have. They are expected to have a pretty good move, but this is not a bad strike price and not a bad premium. I wonder what you get for 20 bucks. So $37, what about $21? You can get $57 with a $21 strike. That seems like a pretty decent play. I might do that one as well. We'll see where Nordstrom's trading going into Tuesday. They report on Tuesday after the bell. So we'll see where they are on probably Tuesday afternoon, and whether or not I make a play on these guys. Another company that's reporting this week is going to be Marvell. It's not something that I generally keep an eye on, but it is something that Jim Cramer likes to keep an eye on. Every night you watch the show, it just seems like this company comes up again and again and again because it's something that I think his investing club is into. But they're a non-profitable company, so it's not something that I'm into. However, if maybe they come down, you can get it, say, around, say, $45 strike, it might be worth it. Let's see what Marvell premiums are. So for Marvell, because they're not profitable, they're one of these 5G players. They do semiconductors for 5G technology. So they're like phones. They'd be like discount Qualcomm, if you will. And so here they are. It looks like where I'd be comfortable doing is say $45. You get $20 a contract. Again, it's not a particularly good contract price, nor is it a profitable company. So it's just one that I'm going to be staying away from, but it is one that they like to hype on that television show. So maybe that's one that some people would like to get in on or some people are interested in. So a $45 strike on Marvell probably isn't the worst thing in the world. All right, so I am still bullish on this market. The reason is because the 10-year treasury yield is still around 3%. And the reason why I'm still bullish is because 3% is still a negative return relative to the rate of inflation, making equities a more attractive investment than fixed income. And for those reasons, I'm still bullish on this stock market, and I don't see that changing anytime soon. All right, so if you got anything out of this, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye. And in other political news, I can't believe they're picking on #1 best prime minister in all the world, Sanna Marin. Apparently, she's only 36 years old. She likes to party. Okay, that's fine. No problem with that. Someone who she used to think was a friend linked pictures to the press. Now she's got to take a drug test. Not sure how I feel about that. But Sanna, power to you. Vote Marin.